Imagine entering a big restaurant with an overwhelming menu, leaving you unsure where to start. Investing in mutual funds feels a bit like that. You have lots of categories in mutual funds, each serving different purpose, and you end up in confusion. In this video, we will explore a crucial concept, how mutual funds are grouped. This is similar to organizing dishes into categories and presenting it on a menu card. So let's dive into the world of mutual fund and understand the categories in it as picking your favorite dish from a well-organized menu. Welcome to holisticinvestment.in. Before dwelling into the categories of mutual funds, let's first explore why they are necessary. To grasp this concept more effectively, let's draw a comparison with something we all cherish: food. Think of mutual fund as a fun street food festival with many food stalls in it. In this busy market, investors are like food enthusiasts, each with their likes and dislikes. Just as some folks enjoy spicy street food and others like simpler snacks, investors have different money goals, risk levels, and plans for how long they want to invest. Food stalls and mutual funds. The stalls in the market are like different types of mutual funds. Someone want to take more risk for higher returns, they can go for equity funds like enjoying spicy food, while others prefer safer choices similar to enjoying basic snack like debt funds. Next, time horizon. Time horizon means how long they plan to invest, whether short-term period or long-term period. The whole market is like the world of mutual funds, offering a bunch of choices to fit what each investor wants. There is something for everyone, whether equity investment or capital protection, that is debt investment, or a mix of both, that is hybrid. Everyone's need is met. Similar to someone exploring a food festival to find what they like, we as retail investors need to explore mutual funds to meet our financial goals. This comparison shows how different types of mutual funds match up with what we want. The different categories are relatively new. In India, in the early 90s, there wasn't many options because the market and economy were just brewing. In the past 2 decades, India's economic growth rate was tremendous. By virtue of it, we have plenty of investment opportunities. As we are discussing how and why the classification matters, it may also be worth checking out the earlier articles about the evolution of our mutual funds in India and how SEBI is safeguarding mutual fund investors. Check the link in the description. Let us go into the topic. Categories of mutual funds in India. There are different categories of mutual funds. This image provides a full universe of types of mutual funds available in India. We have 37 in total, 11 in equity, 16 in debt, 7 in hybrid, and 2 in solution oriented. We will be discussing each subcategory in detail. Equity fund categories. To build a successful investment collection, it is important to understand equity investing. Equity in mutual funds is like adding spice to your investment dish. It offers the potential for higher returns compared to bonds, bringing excitement and flavor. They are known for long-term growth despite short-term volatility. Additionally, equity serves as an inflation hedge. It ensures your investment retains its purchasing power over time. The subcategories are: large cap fund, invest in top 100 company stocks in terms of market capitalization. Large and mid-cap funds invest in top 250 companies with a minimum of 35% each in large cap and mid-cap. Next, mid-cap funds invest in mid-cap companies, that is companies that ranked between 101 and 250 in terms of market capitalization. Small cap fund invest in small cap companies, that is companies that are ranked above 250 in terms of market capitalization. Multi-cap fund invest minimum of 25% each in large, mid and small cap. Next, dividend yield. Minimum 65% of total assets in dividend yielding stocks. Value or contra fund. Minimum 65% of total assets in value stocks or in a contrarian strategy, that is companies having potential to grow. Focused fund. Minimum 65% of total assets in equity, but it limits the number of stocks to 30. Sectoral or thematic fund. Minimum 80% of total assets in a particular sector or a theme, like technology stocks, like that. Next, ELSS. Minimum 80% of total assets in equity and has a 3-year lock-in period. Also, they have a tax deduction advantage under Section 80C. Flexi cap, minimum 65% of total assets in equity, and there is no sublimit under this. Multi cap have some sublimit of 25% under each category. This is the difference between the flexi cap and multi cap. Next, debt funds. The primary goal of investing is to safeguard against downturns, and debt funds play the crucial role of providing stability and protection. Equity funds offer the excitement of higher returns through capital appreciation, while debt funds protect the capital during market turbulence. This balanced strategy, much like walking a tightrope with a safety net, underscores the significance of diversifying investments for a blend of thrill and security in the unpredictable financial world. Overnight funds invest in overnight securities with a maturity of 1 day. Liquid funds invest in debt and money market fund with a residual maturity up to 91 days, that is 3 months. Ultra short duration invest in debt and money market funds with a maturity between 3 and 6 months. Low duration funds invest in debt and money market funds with a maturity between 6 and 12 months. Money market fund invest in money market instrument with a maturity up to 1 year. Short duration fund invest in debt and money market fund with a maturity between 1 and 3 year. Medium duration invest in debt and money market fund with a maturity between 3 and 4 years. Medium to long duration invest in debt and money market fund with a maturity between 4 and 7 years. Long duration invest in debt and money market fund with a maturity longer than 7 years. Dynamic bond fund invest across duration. Corporate bond fund invest minimum 80% of asset in AA plus rated corporate bonds. Credit risk, these fund invest minimum 65% of assets in low rating bonds. Banking and PSU funds invest minimum 80% of assets in bank, PSU and PFI instruments. Gilt funds invest minimum 80% of assets in GSEC across maturities. Gilt 10-year constant maturity invest minimum 80% of assets in GSEC so that the Macaulay duration of portfolio is 10 years. Floater fund invest minimum 65% of total assets in floating rate instrument. Please check out the image attached here. Based on your investment tenure, you can pick the category that suits you. Next, hybrid funds. They are like fruit salad. They have apples, bananas and grapes in different proportions. Now imagine a skilled chef, that is a fund manager, combining apples, bananas and grapes in a bowl. The resulting fruit salad is your hybrid fund. It offers growth potential, steady returns and liquidity. Let's now explore the different types of hybrid funds. Conservative hybrid invest between 10% and 25% of asset in equity and between 75% and 90% in debt instruments. Balanced hybrid invest between 40% and 60% of asset in debt and equity, each with no arbitrage. Aggressive hybrid invest between 65% and 85% of asset in equity and between 20% and 30% in debt instruments. Dynamic asset allocation or balanced advantage invest dynamically between equity and debt. Multi-asset allocation invest a minimum of 10% in at least 3 asset class each. It could be equity, debt, gold, cash or commodities. Arbitrage funds invest minimum of 65% of asset in equity with arbitrage strategy. Equity savings invest a minimum of 65% in equity and minimum of 10% in debt with arbitrage strategy. Next, we are moving to solution-oriented categories. These are funds designed to provide personalized solutions, especially for planning retirement and saving for children's future. You cannot redeem your investment for 5 years unless you reach the retirement age or your child turns 18 before that time. Over time, the average returns in both categories has been similar to overall stock market, but these funds have higher cost. The lock-in is helpful for people who get nervous when the market goes down and might want to pull out. The lock-in makes them stick with the investment for at least 5 years. If you can handle the ups and downs of the market, then better avoid these funds. So these were the types of funds that every investor should know before investing any money in mutual funds. Choosing the right fund depends on your risk tolerance, financial goals, and understanding of each category's composition and tax implications. Keep in mind that risk metrics, tax treatment, and your overall portfolio strategy when making investment decisions. Before moving into the next category, now let's talk about passive funds. Active funds are managed by fund managers. They make decision on buying and selling assets to outperform the benchmark index. But passive funds aim to replicate the performance of a specific index. In active funds, fund managers make decisions to beat the benchmark and provide potentially higher returns. Meanwhile, passive funds aim to mimic the performance of a specific index, providing investors with an easy way to invest in all the stocks or bonds within that index. Indices in India include S&P, BSE, Sensex, Nifty 50, Nifty Next 50, and so on, offering an average annual return of around 14% over the past 30 years. Now let us know about the types of passive funds. Index funds and ETFs. Index funds are a type of passive fund that copies the performance of a specific index like Sensex and Nifty 50, making them more available to regular investors. Exchange traded funds ETFs are another types of passive fund listed on the stock market, allowing daily trading. Unlike index funds, ETFs need a demat account for trading. ETFs show live prices during market hours but might face challenges depending on the market demand. Gold ETFs were among the first ETF in the Indian market. Silver ETFs are relatively new as of 2022. Passive funds can be used to give portfolio exposure to metals like gold and silver. Index funds are often recommended for regular investors who want a simple and cheaper option. Look at the expense ratio and tracking error when deciding the fund. Next, fund of funds and overseas funds. A mutual fund that invests in multiple other mutual funds is known as fund of funds. The concept aims to offer investors diversification by consolidating various funds into one product. Present-day FOFs primarily invest in schemes of same fund house and are used for life cycle funds and overseas funds, offering a simplified option for investors. FOFs have gained attention for facilitating investment in exchange-traded funds without the complexities associated with the direct ETF investment. For instance, the Bharat Bond Fund of funds exclusively invest in Bharat Bond ETF. Overseas FOFs provide an opportunity for geographical diversification in foreign stocks without need to navigate international brokerages. These funds bear the expense of underlying fund and can charge investor an expense ratio within the SEBI limits. Here is the summary of this video. Being financially wise is all about making yourself aware of different investment schemes, understanding the market dynamics, and more importantly, choosing the right product to invest. The bottom line is you don't need all the 37 categories in your investment basket. You should focus on selecting the funds that align with your financial goals. It is important to strike a balance between equity and debt in your investment portfolio. Different types of funds are suitable for different time frames. So to make it simple, choose a fund that aligns with your goal, risk tolerance, and time frame. A professional financial planner will guide you through the process of investing in mutual fund. Happy investing. You can read a detailed blog about mutual fund categories in our website. The link for the blog is given in the description. Hope you like this video. If you have any questions related to this or any other investment option or related to your financial goal, don't hesitate to book a free appointment with our financial planners. The link to the free booking is given in the description box below. Also, will you be interested to attend any insightful investment webinar? Then feel free to register for the upcoming Enlightening Investment Webinar. It is completely free. The registration link for the upcoming webinar is also given in the description box. If you like this video, please give us thumbs up. Also, share it with your social circle. If you haven't subscribed our YouTube channel so far, please subscribe now.